Hello everyone, today we are going to explain chapter 1, accounting and the business environment. All we are going to know what are the main learning objectives of our chapter. Actually, the learning objective of that chapter is including explain why accounting is important and list the users of accounting information. Second, to describe the organizations and rules that govern the accounting. 3, to describe the accounting equation and define assets, liability, equity, use the accounting equation to analyze transactions, prepare financial statements, use financial statements and return on assets to evaluate the business performance. First, we are going to start by explaining why accounting is important and list the users of the accounting. First of all, we have to know what accounting means. Accounting is the information system that measures business activity, processes the information into reports, communicate the result to decision makers. Actually, accounting is an information system, and in any information system, we have 3 components. We have input, output, and processes. The input is any financial information, and the output is what we call the financial statement. And in order to reach from input to output, we need to have something we call processes. Okay, type. So actually information system measures the business activity, including all the inputs that happen inside the organizations or the business, to process this information into reports, and that report is used to communicate the result to the decision makers, which means at the end, the main objective of accounting is to provide information. Okay. We have to differentiate very well between 2 types of accounting or 2 branches of accounting. We have financial accounting, and financial accounting is mainly for external decision makers, as you can see here, such as investors, the people who invest their money inside the company, creditors, the people who or the organizations that or institutions that are owing lending money to the business, and the taxing authority or the taxation authority, the government authority that is responsible for getting taxes from the company based on whatever profit they are achieving every year. This part is the one that we are concerned with in our chapter and in our course here during the first part of our semester. And actually, it is totally different from what we call managerial accounting, because actually managerial accounting is provide information for internal decision makers. Yani the main difference between financial accounting and managerial accounting is that financial accounting is targeted towards the decision makers that are external or outside the organization, and the managerial accounting is providing information to the internal decision makers like the management, like the employees, whoever inside the company. Okay, this was learning objective number 1, and learning objective number 2 is to describe the organization and rules that govern the activity. As you can see here, the organization that rules and govern accounting, something we call the generally accepted accounting principle. Generally accepted accounting principle. And actually, the generally accepted accounting principles are providing information, as we said, because the main information, the main task of the accounting is to provide information to users. This information must be relevant and faithfully representative. Relevant, which means it is related to whatever decisions to be taken by the users. Yani if you are an investor and you would like to take a decision in investing some money in one of the companies, you have to find enough information that will support your decision or help you to take your decision in investing in that company. And at the same time, the information must be faithfully representative, which means it must be accurate, it must be reliable, it must be true, because actually the users will depending on that in taking their decisions. The rules that govern accounting, we have four main rules: economic entity assumption, cost principle, going concern assumption, and monetary unit assumption on monetary unit assumption. Actually, if we started by the first one, which is the economic entity assumption, an organization that stands apart as a separate economic unit follow the economic entity assumption, which means all the organizations in accounting are to be considered as a separate legal entity, which means it is separate from their owner, which means in accounting we are recording the transactions that have been conducted by the company or the institution rather than by the owner, which means in accounting we are dealing with the organization as an artificial person. Artificial person as if it is a normal person that is acting by itself. So actually in all our records we are dealing with the company as a separate legal entity. Continuous life and transferability of ownership, because actually the companies are remaining because they are separate from the life of their owners. Actually they are continuing in life even if their owners have deceased or died. Actually the company will continue with their heirs. So actually the company here has a continuous life, and it is very easy to transfer its ownership, especially if we are talking about a corporation. So in that case, and as a result of that, the company is separate legal entity and it has a continuous life, it has no mutual agency, which means no one inside the company have any thing to do with the ownership, and in the same time the owners cannot act on behalf of the company because the owners actually elected or selected the owners, the management board, and the management board is the one that is running the business. So here the owner cannot take any decision on behalf of the management. Limited liability of stockholders. Limited liability of stockholders. Stockholders are the owners of the company, and they are persons who own the stocks, because in corporation the ownership is divided into large number of stocks. So actually whoever will purchase or buy these shares will be called shareholder. But actually the maximum that you can lose is the amount that you paid for that shares. For example, if you are purchasing a group of shares for $1,000 and the company has loss of $10,000, actually the maximum that you are going to lose is the 1,000. So here we have a limited liability of stockholders. You cannot lose more than what have you paid before in purchasing that stocks. And the separation of ownership and management, and this is what we were talking about. The ownership is something and the management of the company is another thing. The second is the cost principle. Cost principle, or the historical cost principle, is a principle that's telling us that the company should record their assets at their cost, the original cost that we purchased the assets with. For example, if I purchased a building for $10 million, I will keep recording that building for $10,000. Actually, because the cost is easily verifiable, okay, that we are using the historical cost principle, although the fair value information may be more useful in order for the investors, creditors, the government to know what are the current value of the asset, because maybe you purchased the building for 10 million 2 or 3 years ago, but actually now it's worth more or less, and you are not reflecting that in your financial statements because we are in adherence to the cost principle, or in compliance to the cost principle. And this is actually one of the main principles that most of the people outside accounting are criticizing, because they are not showing the current value. But actually our main objective here is to be objective, to be verifiable. This is why we are insisting on the use of the historical cost. The third is the monetary unit assumption. The monetary unit assumption. Monetary unit assumption means that the books of accounting cannot include anything that we cannot record or measure in money. If you are able to find a value for anything, this thing can be recorded in the accounting books. On the other hand, anything that you cannot measure in money cannot be recorded in our books. This is what we call the monetary unit assumption. The monetary unit assumption. Again, the economic entity assumption requires that activity of the entity be kept separate and distinct from the activities of its owner and all other economic entities. And as we said, we have three forms of business ownership: proprietorship, partnership, and corporation. The three forms of the ownership is proprietorship, partnership, and corporation. And actually, in order to understand, well, I will be moving here to that slide in order to show the different characteristics of each form of business ownership. The first one, which is the proprietorship, is generally owned by one person. Often it is a small service type businesses, and the owner receive all the profit and suffer all the losses, which is personally liable for all that. In a partnership, two or more are and actually it is always or often a service type of business, and generally it has unlimited personal liability, which means also the partners here are receiving any profit, suffering from any losses, okay, even in their personal properties. And actually we have an agreement that determine in some cases that the losses can be shared in a specific percentage according to their investment in the company. This is why we say that the partnership agreement is determining what are the profit shares, what are the the losses shares, and who is responsible for the management of the company. In corporations, the ownership is divided into shares or stocks all over a large number of owners, and actually it is considered as a separate legal entity organized under corporation law. In Egypt we call it the companies law, قانون الشركات, and actually it has a limited liability, which means you cannot lose more than what did we pay in the first stocks. The learning objective number 3 is to describe the accounting equation and to define assets liability. Accounting basically is the core of accounting, which means this is the core of the accounting process. Without that equation, we cannot say that we have any accounting at all. And the equation is saying that assets equal liability plus equity. And if you can see here, this equation or this equality sign, equal sign here, that says that whatever you own or control here as an asset must equal the total of liabilities and equity. So actually here, if you would like to purchase anything, like for example a suit, and you have 1,000 Egyptian pound in your hands or in your pocket, plus that you have a credit card that giving you a credit limit with another 500, you cannot purchase anything more than the 1,000. This is why the equation is always equal, because actually the right hand side is to be considered as resources to finance the left hand side. So this is the main core of accounting. Any transaction to happen inside the company, it must affect that equation and keep it equal. Keep it equal, which means the two sides must be equal. Right. For the first while, we have to know what do we mean by asset. Asset is any economic resources that expected to benefit the business in the future. Whatever the company will acquire in order to yield, return an economic benefit in the future, like cash, merchandise inventory, furniture, land, and anything else that can be considered as an economic resource. Liabilities are debts, what the company is owes to others. And many liability have the word payable, which means anything that is payable is to be considered as a liability. On the other hand, anything that is receivable will be considered as an asset type. Like what? Like accounts payable. We are owing money to others. Notes payable. This is for the short term and this is for long term. Okay, and salaries payable. Salaries that are due but not paid yet by the company. And last but not least, the equity and the owner's claim to the assets of the business and called equity. This is the amount to be invested by the owner of the company in the business. This is the capital. This is the initial investment. And actually the initial investment in the stockholders is in the corporation is called the stockholders equity. Stockholders equity. And actually our equity is to be increased by the contributed capital. The more the investment to be received from owners, this will increase the equity of the company. Whenever the company is achieving revenue, this will increase the equity. On the other hand, dividend, which is the distribution of profit. Whenever the company is making profit, at the end of the year, the company is paying part of that profit to the owner as a return on their investments. This is to be called dividends. And this will be taken out of the revenue. Okay, so actually minus expenses, which is net income. So actually the revenue will increase, but the expenses will decrease. The dividend will decrease. So actually the equity will increase by two items: the contributed capital, the more investment to be made by the owners, and the revenues, and to be decreased by dividend and expenses. Okay, fine. The equity consists of two main components, something we call the contributed capital, and this is what we just said, the equity, and the other one, it is called paid-in capital, and it is the amount invested in the corporation by its owners, right? Okay, and it can be called also common stock. In the American accounting, it is called common stock, and it represents the basic ownership of every corporation. So the contributed capital or the common stock or the share capital are all synonymous. They are all referring to the same thing. And the retained earning is what we keep the profit in during all the year or starting from year one of the company. يعني for example, if you can see here, this is the equation. This is the assets that we talked about. This is the liability, and this is the equity. And if you can see here, this is the contributed capital, the common stock, the share capital, decreased by dividend, as we said before, increasing by revenue, decreasing by expenses. But actually, this part alone is to be called as retained earning. Retained earning. So actually, dividend is the profit distribution. Revenue is whatever you receive against providing service or selling goods. Expenses is what to be incurred against generating these revenues and running the operation of the company. So actually those two accounts are resulting in something we call net income or net profit. The net income or the net profit, if the revenue is more than expenses, we have net income. If the revenue is less than expenses, so it is net loss. And in that case, if it is net income, it will increase the retained earning and by default increasing the equity. Or if it is net loss, so actually it will decrease the retained earning and by default decreasing the equity. This is very, very important to understand in accounting. Right. The learning objective number 4, to prepare the financial statements. Financial type. What are the main financial statements that we have? We have income statement, we have statement of retained earnings, and we have balance sheet, and we have a statement of cash flow. Actually, in our course, we are going to cover income statement, retained earning, balance sheet, and the cash flow will be covered in other courses. Type net income or income statement, providing information about profitability of particular period of the company, and is to be prepared by adding all the revenue and subtracting all the expenses. And this, as we said before, whether it is either to be net income or net loss. Statement of retained earning informs user about how much of the earnings were kept and reinvested in the company. And this is the retained earning we talked about. Retained earning beginning plus net income, as we said before, or minus net loss if it is loss, minus dividend equal to retained earning. And then we have the balance sheet, and the balance sheet including assets, liabilities, and stockholder equity. Assets, liabilities, and stockholder equity. And the cash flow is telling me what are the cash in and cash out, the cash receipts and the cash payment for the company during specific period. Very well. Type. Let's see the format. This is the format of the income statement. When you do the income statement, we have formalities that we have to follow. The first is to write the name of the company. This is a must, which means if you didn't do it, you are missing part of the statement. Then the name of the statement, income statement, and then the date. Those are three headings that must be included while you are preparing the income statement. So actually this is revenues, service revenue, expenses, which is expenses as you can see, and net income. Okay, يبقى revenue minus expenses equal to net income. Right. Statement of retained earning. Again, the name of the company, the name of the statement, and the date. And we start by the retained earning beginning. If this is the first year for the company, then it will be 0. Net income for the months from the income statement, and then minus dividend. So this is the retained earning and balance. And the statement of retained earning report how the company retained earning changed from the beginning to the end of the period. Okay, and you have to know that the statement are to be prepared in order, which means we have to start by the net income, by income statement, then the statement of retained earning, because actually we use the net income from the income statement in preparing the retained earning statement, and then the balance sheet will be reported. Okay, well, we'll be reporting the assets, liability, and the stockholders' equity. And as you can see here, again, the name of the company, name of the statement, and the date. We have assets, liabilities, okay, we have cash, accounts payable, office supplies, land, total assets, accounts payable, stockholders' equity, common stock, retained earning, total stockholders' equity. And as you can see here, the total assets are equal to the total liabilities and the stockholders' equity section. And this is a must because, as we said, the balance sheet is representing the accounting equation. The accounting equation. Type. And this is the cash flow, and we said that we are not going to cover that part. But here I'm saying that it includes the cash in and the cash out for the specific activities of the company. Objective, learning objective number 5 is to use the accounting equation to analyze the transaction. And this is important part. The transaction is any event that affects the financial position of the business and can be measured with faithful representation, like buying a computer for the office for 2,000 cash. Actually, this is a transaction that must be reflected in the books of the company. So actually, this will be considered as a transaction. Okay, type. Are the following events recorded in the accounting record? For example, supplier are purchasing an account. Is that a transaction to be recorded? Yes, it is, because we can find out the value of supplies, so actually we can record it in the books. What about hiring an employee? Is that a transaction to be recorded in the book? Actually, no, because when you hire the employee, when he is signing the contract, actually nothing affected the resources of the company. So actually, we cannot record it now. When to record it? When the employee coming and stay for 1 month, for example, and he deserves the salary. When he deserves the salary, this is an expense that must be recorded in the books. Owner withdrawal cash for personal use. If the company got, for example, cash withdrawal or dividend, this is a transaction that we have to record. This is an example that's showing us group of transaction and how it will affect the financial accounting equation. For example, he is saying that Sheena Pride contributes 30,000 cash to Smart Touch Learning, a corporation, in exchange for stock. This is the equation: assets, liabilities, and equity. The cash will increase because we said the company is to be considered as a separate legal entity, so the cash will increase and the common stock will increase, because actually we have to keep balance between the two sides of the equation. So again, this is cash and this is common stock, and both must increase. The cash increased in the company and the equity of the owner in the company also. We purchased land for cash for an office location, paying cash of 20,000. So actually again, the cash has 30,000 balance from the previous transaction. We paid, so the cash decreased by 20,000, so the new balance is 10, and another asset have arisen, which is land, by 20,000. So the two balances are still, the two sides are still balanced, which is equal to 30. Transaction 3, purchase office supplies on account. Smart Touch Learning buy office supplies on account, which is a liability called accounts payable, agreeing to pay 500 within 30 days. We purchased an asset, the office supplies increased by 500, but we didn't pay. We paid by credit. Like when you buy something using your credit card, you are not paying now, but you are liable to pay later. So the liability will increase by another 500. So actually still we have balance in that equation. Transaction 4, earning of service revenue for cash. Smart Touch Learning earn service revenue by providing training service for client. The business collect 5,500 in cash, which means that the company did a service, so actually they collected 5,500, and this is a service revenue because it has been collected against service that has been provided. So the service revenue increased, which means that the revenue increased, the retained earning increased, and the equity increased. Earning service revenue on account. We did a service, but actually the client promised to pay the 3,000 within 1 month, which means we didn't receive yet. So actually cash will not be affected, but we will have an account receivable. Account receivable is something telling me that the company is entitled to receive cash from somebody else for that amount, for 3,000. So why you are entitled for that? Because actually you provided service revenue, you provide service for someone, so your revenue increased. So actually both sides are still in. Payment of expenses with cash. Smart Touch Learning pays 3,200 in cash expenses, 2,000 for office rent, 1,200 for employee salary. So actually here, because we paid, the cash will decrease by the total, and we have expenses to be deducted from the service revenue under the retained earning. So actually the equity has been decreased. Okay, and this is, as you can see, 3,200, and this is 3,200. Payment on account, which is accounts payable. Smart Touch Learning pays 300 to the store from which it purchased office supplies in transaction 3. Okay, we paid 300, and the accounts payable out of 500 that we owing, okay, the store has been decreased by the 300. So actually again the two sides are. Collection on accounts. The client provided us with 2,000, which means we collected 2,000 out of the account receivable. So the cash increased by 2,000 and the account receivable decreased by 2,000, which means here the effect is 0 on that side and nothing happened here. So the two sides are still equal, if you can notice that. So from that transaction specifically, we can say that the transaction can happen in the same side with two different signs, positive and negative, which means the effect will be 0. The effect will be 0. Transaction 9, payment of cash dividend. Smart Touch Learning distributes a 5,000 cash dividend to the stockholder, China Pride, which means the cash will decrease. We are distributing part of the cash, and we say dividend under retained earning will decrease the retained earning, so the equity by default will decrease. This is a summary of all the transactions that have been done, and at the end I'm proving that all the transactions kept the balance and I added the ending balance of both sides, so actually they are equal. If they are not equal, you have a problem. You cannot continue the accounting cycle, and this will be considered as a big problem. So you have to go back and review what you have done in order to be sure that all the transactions have been recorded. At the end, this is using financial statement and return on assets to evaluate the business performance. Actually, this is one of the ratios, the main ratios that we are using in order to measure the profitability of the company, and it comes by dividing the net income of the company, revenue minus expenses, over the average total assets, and the average total asset is coming from beginning total assets plus ending over 2, and this is something we do in order to measure the profitability of the company. By that we ended chapter 1. I got all what I said. If you have any questions, we are going to discuss that in the class, inshallah, soon. Thank you very much.